Hey traders, welcome back to TradeSync. In today's video, we're diving into breaker blocks, what they are, how they form, and how you can use them to find high probability trade setups. Let's get into it. First, what is a breaker block? A breaker block happens when an old order block fails, price breaks through it, and later comes back to that same level, which now acts as a strong area where price reacts again, often as support or resistance. We know that when price breaks above a resistance level, that level often turns into support. And when price breaks below a support level, it can turn into resistance when price comes back to it. The same thing can happen with order blocks. Sometimes an order block, whether it's supply or demand, fails to hold. That can happen for a few reasons. The market might be shifting direction, reacting to higher time frame levels, or simply no longer respecting that zone. When price breaks through a supply zone and comes back to it later, that same area can now act as demand. And when this happens, we call it a breaker block. It's basically a failed order block that flips its role. What was once supply becomes demand, or the other way around. This flip often creates a strong reaction area where traders expect price to bounce or reverse. Now, let's dig a bit deeper and look at more examples and confirmations we need before taking a trade. Number 1. Before you even think about breaker blocks, you need to understand the current market structure. That means knowing where price is heading, spotting key supply and demand zones, checking higher time frame levels, identifying areas of liquidity. Number 2. Price action confirmation. There are many price action signals that help confirm a breaker block. For example, smaller candles as price approaches the level can show it's losing strength. Then, a long wick candle rejecting the zone tells us there's a strong reaction. After that, a change of character shows a possible shift in direction. By using these signs, you can confirm breaker blocks and improve your trade setups. Now let's use all these concepts live and look for a trade setup together. Here we have the Japanese yen on the 4-hour chart. We can clearly spot an order block. We call it an order block for now because we don't yet know if price will break through it and reverse direction, or reject it and continue moving upward. Let's see how price reacts to this zone so we can make our decision. As we can see, price just broke through the zone with a strong bearish candle. This means the order block has failed and now becomes a breaker block. It's now a potential supply zone, and we'll wait to see if price comes back to it. That's where we'll look for a short trade. But if price ignores this area and keeps falling, or pushes back above it strongly, then this breaker block becomes invalid. Let's wait and see how price reacts. Now, we see price has rejected the area, and there are multiple rejections from the zone. Another key point. Price has shown a change of character, indicating a potential shift in direction to the downside. That gives us a trade setup. We can place our stop loss just above the breaker block and target 1 to 2, or whatever fits your risk management plan. In this example, we're looking at the Nasdaq on the 4-hour chart. Price dropped sharply, then started forming higher lows, showing early signs of a shift. After a strong bullish move, buyers took control. At the top, we can see a clear order block formed after grabbing significant liquidity. If you're trading breaker blocks, you need to wait for price to break above this order block. That confirms it as a valid breaker block, giving us a clear setup. But if price rejects from the order block and continues falling, it's no longer a valid breaker block, just a failed reaction. If you trade regular order blocks, you'd already be in from the first touch as price drops. For now, the only thing to do is wait and see how price reacts at this key level. Price broke the order block, turning it into a breaker block. A strong rejection has already formed from the zone, confirming the uptrend after the breakout. Now we're ready to enter the trade, with the stop loss placed below the breaker block and a target of 1 to 2 risk to reward for this setup. On Nasdaq 15-minute, We first see a swing high, followed by a swing low. Then, there's a strong bullish move that breaks and closes above the previous swing high. This breakout creates a valid order block, showing clear demand and interest in long positions. Now that the buy-side liquidity is taken, the market suddenly reverses direction. It pushes downward and eventually breaks and closes below the low of that last bearish candle. This marks a change in market structure, turning from bullish to bearish. Because of this shift, the same bullish area now becomes a bearish breaker block, a place where we expect the price to get rejected if it comes back. This suggests that buyers from earlier have been stopped out and selling pressure has taken over. As price returns to this zone, it pauses for a bit, building up more buy orders. Then, it gains momentum and moves downward again, continuing the bearish trend. In another example, we have something different. This area was initially a bearish order block. Price reacted with a short-term decline, confirming some selling pressure. But instead of continuing lower, price reversed and broke above the high that originated the bearish move. This invalidation tells us the bearish order block has failed. When an order block fails like this, meaning the market breaks structure in the opposite direction, the zone often transforms into a breaker block. In this case, a bullish breaker block. Price retraced back to the same zone, and instead of rejecting it as resistance, it respected it as new support. This shift in role is what defines a breaker block. Now, look at what forms around the same time. A clean bullish order block forms just beneath the breaker. It's created by the last down candle before the aggressive move upward that broke structure. This gives additional confluence, because now the breaker block is located inside a valid bullish order block. The result is a nested setup, a breaker block inside an active bullish order block. This kind of formation typically offers a strong area for entries, especially when aligned with the overall market trend and confirmed by price reaction. In summary, a failed bearish order block reclassified as a bullish breaker, reinforced by a new bullish order block. Price respected the zone perfectly, offering a high probability continuation setup. Breaker blocks are a powerful tool when it comes to spotting market reversals. By recognizing failed order blocks and combining them with key price action signals, you can identify high probability setups that others might miss. But remember, it's not just about identifying the zone, it's about understanding market behavior, confirming with smaller timeframes, and managing your risk effectively. Keep practicing, stay disciplined, and don't rush the process. If you found this content valuable, be sure to like, subscribe, and hit the notification bell for more in-depth trading strategies. Thanks for watching, and I'll catch you in the next video.